A quiet retaliation, the IPO that rocked the markets. The U.S. government made a seemingly innocuous request. It asked J.P. Morgan Chase and Bank of America to withdraw from a prominent Chinese IPO in Hong Kong. This request, however, was anything but ordinary. It signaled a shift in U.S. policy aimed at limiting China's economic rise. China's response was quiet, but forceful. Beijing began selling off U.S. Treasury bonds. This was a clear signal. China was willing to use its financial clout to send a message. The move exposed an underlying tension in the U.S.-China relationship. It brought to light the growing economic rivalry between the two superpowers. The seemingly minor IPO dispute had become a much larger proxy battle. The incident served as a wake-up call. The global financial system, long dominated by the U.S., was entering a period of uncertainty. China, with its vast reserves and growing economic might, was no longer content to play a passive role. It was clear that a new chapter was being written in the story of global finance. The Great Unwinding. China dumps U.S. debt. China's selling of U.S. Treasury bonds was not an isolated event. It was part of a deliberate strategy to reduce its exposure to the U.S. dollar. For years, China had been accumulating vast reserves of U.S. debt. This was a byproduct of its export-driven economic model. However, as China's economy matured, its leaders recognized a strategic vulnerability. Holding trillions of dollars in U.S. debt gave Washington leverage over Beijing. China's leaders saw this as an unacceptable risk. They began a gradual but steady process of diversification. This involved reducing their holdings of U.S. Treasury bonds. It also meant investing in alternative assets. Gold became a particularly attractive option. Seen as a safe haven asset, gold offered protection against inflation and currency fluctuations. China's central bank steadily increased its gold reserves. This move was closely watched by market analysts around the world. The golden cushion. China's strategic gold reserves. China's accumulation of gold was not driven by speculation. It was a strategic move to bolster its financial independence. Gold, unlike paper currencies, is not subject to the whims of central banks. It has intrinsic value that transcends national borders. By holding substantial gold reserves, China aimed to reduce its reliance on the U.S. dollar. This strategy was in line with China's broader geopolitical ambitions. As China's global influence grew, so too did its desire for a financial system that reflected its stature. The existing system, dominated by the U.S. dollar and Western institutions, was seen as outdated. China sought to create a more multipolar world order, one in which the yuan played a more prominent role. The implications of China's gold strategy were far-reaching. It signaled a loss of confidence in the U.S. dollar as the world's reserve currency. This had the potential to undermine the U.S. financial system. It also raised questions about the long-term stability of the global financial order. Looking east, yuan-based bonds and infrastructure investment. China's financial strategy extended beyond just selling U.S. Treasury bonds and buying gold. The country was actively promoting the use of its own currency, the yuan. It encouraged the issuance of yuan-denominated bonds. These bonds, known as panda bonds, offered an alternative to dollar-denominated debt. They allowed foreign borrowers to tap into China's vast savings pool. China also made significant investments in infrastructure projects throughout Asia, Africa, and Latin America. These investments were often financed in yuan. This helped to internationalize the Chinese currency. It also created a network of countries with a vested interest in the yuan's success. China's efforts to promote the yuan were part of a broader push to reshape the global financial landscape. The country aimed to create a system that was less reliant on the U.S. dollar, one that gave emerging markets a greater voice. Section 5. The Rising Sun. China invests in Japanese government bonds. In a surprising move, China increased its purchases of Japanese government bonds. Japan, a close U.S. ally, has long been seen as a pillar of the Western-led financial order. China's investment in Japanese bonds was a strategic move. It allowed China to diversify its foreign exchange reserves. It also sent a message to Washington. China was willing to forge financial ties with U.S. allies, even as tensions between Beijing and Washington rose. The move highlighted the complex geopolitical dynamics at play. While China and Japan had their differences, they also shared common interests. Both countries recognized the need for a more stable and multipolar global financial system, one that was not solely reliant on the U.S. dollar. China's investment in Japanese bonds was a sign of the times. It reflected the shifting balance of power in the global economy. It also underscored the growing importance of Asia as a center of financial influence. Section 6. Washington's response. Legislation and financial decoupling. The United States government viewed China's financial maneuvers with growing alarm. Lawmakers from both parties expressed concern about China's growing economic clout. They worried that China was using its financial might to undermine U.S. interests. In response, the U.S. Congress passed a series of bills aimed at curbing China's economic influence. These measures included sanctions on Chinese companies. They also restricted Chinese investment in sensitive U.S. industries. The Trump administration also launched a trade war with China. It imposed tariffs on billions of dollars worth of Chinese goods. These actions marked a significant escalation in the economic rivalry between the two superpowers. The U.S. government's actions were driven by a desire to protect American jobs and industries. However, they also risked further destabilizing the global economy. The trade war with China led to higher prices for consumers and businesses. It also disrupted global supply chains. Section 7. The Domino Effect, Impact on U.S. Investors and Markets. The escalating financial tensions between the United States and China had a ripple effect throughout the global economy. U.S. investors, accustomed to the stability of the U.S. dollar, began to worry about the safety of their investments. The stock market experienced heightened volatility. The trade war with China created uncertainty for businesses. This led to a decline in investment and economic growth. The U.S. government's efforts to decouple from China also had unintended consequences. By restricting trade and investment, the United States risked isolating itself from the world's fastest-growing economy. This could harm U.S. companies and workers in the long run. The financial conflict between the United States and China highlighted the interconnected nature of the global economy. Actions taken by one country could have far-reaching consequences for others. It also underscored the need for cooperation and dialogue to address shared economic challenges. Section 8. Building a Parallel Universe, China's Independent Financial System. China's response to U.S. pressure was not merely defensive. The country was actively building an alternative financial system, one that was less reliant on the U.S. dollar and Western institutions. This included the establishment of new financial institutions, such as the Asian Infrastructure Investment Bank and the New Development Bank. These institutions provided financing for infrastructure projects in developing countries. They offered an alternative to the World Bank and the International Monetary Fund, which were seen as dominated by the West. China also created its own credit rating agencies to challenge the dominance of Moody's, Standard & Poor's, and Fitch. These agencies had long been criticized for their Western bias. China's efforts to build a parallel financial system were a direct challenge to the existing global order. They represented a shift away from the U.S.-led system towards a more multipolar world. Section 9. A New Dawn, the End of Dollar Dominance. The financial maneuvers by China and the United States signaled a potential turning point in the global economy. The U.S. dollar's status as the world's reserve currency, long unchallenged, was facing its most serious threat yet. China's growing economic might, coupled with its efforts to internationalize the yuan, raised the prospect of a multipolar financial system, one in which the dollar shared its dominance with other currencies. The implications of this shift were profound. A decline in the dollar's dominance could lead to higher interest rates for U.S. borrowers. It could also undermine the United States' ability to finance its budget deficits. Moreover, a multipolar financial system, while potentially more stable in the long run, could also be more prone to volatility and uncertainty in the short term. The future of the global financial system remained uncertain. However, one thing was clear. The era of unchallenged U.S. financial dominance was coming to an end. The world was entering a new era of financial multipolarity, one in which China was poised to play an increasingly important role.